Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. We've got a great show here for you in the second segment. In the first segment, we talked a little bit about savings rate, and I just wanted to expound on that a little bit further before we move on. But with all the talk about the poor economy and the poor returns in the stock market and all this sort of thing, people lose sight of the number one determinant of your financial future, and that is how much you save, spending less than you make. Now, I realize that if you've lost your job or something like that, this can be difficult, but the number one determinant is saving more than you make. I mean spending less than you make and saving. For example, I mentioned if you made $100,000 a year and you were saving 5%, that's only $5,000 a year that you're saving. There's no way that will, if you work for 30 years, that's only $150,000 that you have saved, and you expect that the rest of your life. There's no way that's going to happen. Instead of complaining about the rate of return that happens to be available in the market today, if you were to simply boost your savings rate from $5,000 to $10,000 a year, 10%, that is a 5% return on your money. If you're making $100,000 a year and you put in 5% more into your savings, investments, that's a way to give yourself a rate of return. Anyway, I just wanted to emphasize that especially in times like now when the economy is uncertain and the returns are not there, now is the time to build up that capital base so that when things do turn around, you have some money put away to multiply. Okay, I wanted to talk a little bit about what to look for in this fourth quarter. We already touched base the past couple weeks about after such a disastrous quarter that we had across virtually all asset classes other than long-term treasuries, that typically the fourth quarter would be very strong. The last part of the third year of a presidential, in fact, this is the third year of President Obama's presidential term. Historically, there's never been a third year of a president in the modern era that the returns of the stock market were not greater than zero. Anyway, so we thought that the fourth quarter would be strong going into the year end. Seasonality, typically this is the strongest period of the year for returns from now through about February or March. So there are a lot of things. Moving on to a more fundamental level, there's also some good fundamental things going on in the economy that bode well. Of course, all this is predicated on what people were concerned about was a double dip recession. So what I want to do is talk about today a little bit of things that maybe you can look for if you're investing and concerned about what's going on. So the first thing obviously is the economic conditions. What is going on in the economy? We've seen some relatively positive manufacturing data, employment data. I know the unemployment rate is still way too high, but somewhat positive data coming out of employment that could help the economy significantly. That would also encourage corporations to buy back their stock as well as to put some of that cash hoard to work. So we're paying close attention to the economic conditions, manufacturing activity, as well as that pesky unemployment rate. If those continue to show signs of at least stop going down and maybe perking up a little bit, I think you'll see economic activity at companies perk up, put some of the cash they have available to use. The other thing we look at is earnings season. In the average quarter since 1994, 62% of the earnings reports have been positive surprises. During quarter two, the percentage of surprises was 69%. And what this means is every quarter, sort of analysts get together and they try to project what the company will earn. Say Coca-Cola, they think they're going to earn $1.50 a share. Well, an earnings surprise is when they estimated too low and the earnings were actually higher, which, by the way, that should show you something about the accuracy of trying to predict earnings. If you caught that, since 94, 62% of the reports have been positive surprises. The rest, of course, negative. It very rarely ever is what they thought it was going to be. Anyway, the point is that in the last quarter, this percentage ramped up to 69%. So the majority of the companies were earning more money than analysts on Wall Street thought, which is that's a good sign. When this happens, investors become more positive and they continue to bid up the price of stocks. The market for earnings is somewhat mixed, because when earnings go up a lot, the following year it becomes more difficult to surpass those earnings. However, we think that they still can continue to progress, but it's something to keep an eye on. So the first thing to keep an eye on was, in fact, the economic conditions. We like to look at manufacturing activity and unemployment rate. The second thing that we want to look at as we enter this fourth quarter is, in fact, the earnings of companies, the U.S. as well as overseas. We want to take a look at those. And these are two of the factors. We'll continue with some more of the factors we want to look at to determine if the risk off, which happened in the third quarter, is going to prevail in the fourth quarter, or the risk on rally, which started October the 3rd, is going to continue. We want to give you some ideas of things to look for. When we come back from the break, we'll talk a little bit about the market itself, Europe, banks, China, as well as emerging markets, currencies, and commodities. So for All Things Money, I'm your host, David Blain, and we'll be right back talking about a little bit of our outlook for the fourth quarter.